Welcome to the Live Squawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. So good morning, good afternoon, or good evening, depending on where you are, and welcome to the Live Squawk preview stream. Today's program will look at the upcoming US data releases, and we'll touch on the week's events so far, and also look ahead to next week and what everyone's really focused on, the US elections. I'll be joined today by Jason Sen to help guide us through what's expected. Jason began in 1987 on the floor of the London International Financial Futures Exchange at the age of just 19, fellow teenager like myself back in the day. He spent 15 years specializing in market making, interest rates, and index options on the floor, and then later on the screen. And for the past 20 years, he's provided technical analysis based systems and signals, helping others to understand the dynamics of financial markets. So I'm joined by Jason, and today's topic, as I've said, will look at PCE data, personal income, personal spending. We'll have a look at what's expected and the dynamics of that. We'll then look at the non-farm payroll data out tomorrow, and we'll also just cover that. And as I said, we'll then look towards next week's elections and just have a quick scan across last week's data points as well. So on the first point, we'll take a look at PCE. Let me just say hello to Jason. Jason, hello.
Harry, hi mate. Thanks for the invite.
No, always a pleasure. Always a pleasure. I think your first time on our preview show, and so a warm welcome to you. If you just heard what we said, we'll have a look at the data in a minute, and I want to get on to the PCE data first. I don't know if we'll have to spend too much time on it because we've obviously had CPI out earlier in the month, and really sort of a precursor now to the PCE data we see. So it takes away some of that dynamism and I guess impact that we would normally get for a PCE, which is, as we all well know by now, the Fed's favoured inflation gauge. So just to give you a quick look then at what to expect on that from what the analysts have put down, the consensus really for PCE data. He scrambles to get that up. Right, so consensus is for personal income to rise 0.3% on the month versus 0.2% last time out. Personal spending seen at 0.4% in September, rising from 0.2%. Real personal spending expected at 0.3% versus 0.1%. PCE price index seen at 0.2% from 0.1%, with the year-over-year seen at 2.1% versus 2.2%. The all-important core, this core PCE price index month-over-month seen at 0.3%. That's another rise from 0.1%, and the year-over-year seen at 2.6% from 2.7%. If there is some concern about the reversal in trend, we've seen it in Europe. We saw Eurozone inflation data on Thursday, a while back, earlier today, and that saw a little jump. Base effects playing a part in what we saw on that front. So I don't think it's a complete surprise if we do come in above, a little bit above consensus on the prices data, because some of that I think has been factored into what to expect, I guess, for today's PCE. I'm just going to look at a quick bank note on this, just to give you some sort of perspective from the bank sector and what they're looking for. A piece from what we got here from Deutsche Bank on today's reading said the Fed would pay close attention to Thursday's personal income, which is seen up 0.4 versus 0.2, and consumption of 0.3 versus 0.2 reports, which also feature the latest reading on core PCE, the Fed's preferred inflation measure. While we have a pretty good idea of what the September core PCE will look like from the CPI and PPI data earlier this month, this will be the last piece of inflation data the Fed will see before the November meeting. So any surprises could impact officials' views at the margin. So on that note, Jason, let's tackle that and have a quick look at what are your expectations ahead of today's core PCE reading, well, effectively core PCE, but personal spending?
Well, I haven't calculated down any numbers myself, which you won't be surprised to know. But I suppose the question is now, is inflation looking a bit sticky around these levels after coming down significantly during the year? I don't know if I have an answer for that, but it's quite interesting because I think the expectations that you gave are a little bit above last month's number. And I know that average earnings have been creeping up a little bit, and we've got that number out on Friday. So maybe inflation is a little bit sticky around this area.
Yeah, I mean, if you look at, as I said, base effects will play a part in what we're likely to see. Again, I've got a city note here on the core PCE. They look for it to be a bit stronger over the last few months, and so there is some potential for further strength in October from components like medical or financial services, but they still see core inflation to average close to 2% over the coming months, which is obviously favourable for the Fed and where the Fed wants to see it in the medium term, I guess. So from that perspective, there's not a great deal that would likely change their opinion if we come in as expected on these numbers today.
No, that's true. But yeah, certainly the economy is holding up quite well. And throughout the year, things have changed quite. At the beginning of the year, everything looked like inflation was collapsing. Then middle of the year, inflation not so bad. Now it's easing off again. We took some big interest rate cut last month. So the situation does seem to change every 2 or 3 months.
Yeah, and just on again, we say it changes every 2 or 3 months, but I mean the Fed's, in terms of where would you come at this from a trader's perspective, and what would you be looking at in terms of not just today's PCE data, but obviously we have tomorrow's non-farm, which we'll come to in a second, which we should be a bit of a mess, really, considering all the hurricanes and everything else we've had the other inputs into that. So we'll have a look at that, and also yesterday's GDP as well. Again, like you said, showing a steady performance from the US economy. So I mean, in terms of the rate outlook, I don't think, and we won't dwell on it, but there isn't a great deal at the moment that's likely to take them off course from their current expected rate path of another 25 basis point rate cuts this year.
Yeah, that's true. And the Fed telegraphs things so well these days anyway, compared to the days when you and I were on the floor and we wouldn't have a clue what the central bank was about to do. So, yeah, the picture's pretty clear. I know that the dollar's had one heck of a run higher recently. The dollar index was around the bottom of the range for the last 2 years. I was wondering if it was going to break down. Clearly it didn't. And it's had one heck of a run up. So I don't know whether that can continue. I've got a feeling that was down to a large number of speculative shorts that got squeezed.
So you put that's more of again like a structural thing as opposed to a change in opinion or whatever. I mean, there has been murmurs that we could see them, even the Fed, take a step back. But I don't think it's a widely held view. But with the economy holding up as well as it is, I guess there is that element of a risk that they could say, look, we've done what we've done so far. The economy seems to be on a steady path, and we don't want to really overstimulate matters and reinvigorate inflationary pressures. But I guess we'll have to wait a few more readings for that to be the main case on that front, I guess. But as I said, on the inflation side, I think you're right. I think in terms of any dynamics here in today's core PCE, in Thursday's core PCE report, it will take a bit of a swing to to change momentum. I'm going to move on quickly to non-farm payroll because I want to get onto that and then really look at how that's going to sort of affect traders' thinking really around that. So if I get up the preview for that and just get the consensus for that. Okay, so as it stands right now, non-farm payroll is expected at 101,000. The general consensus. Again, that's a big chunk lower than 254,000 seen last month. In terms of private payrolls, that's seen adding 70,000 from 223,000 last time out. Manufacturing payroll is expected to drop by 30,000 after losing 7,000 jobs previously. The unemployment rate seen on hold, though, at 4.1%. Average hourly earnings seen at 0.3%, down from 0.4%, with that year-over-year figure seen unchanged at 4%. In terms of the average weekly hours, all employees, we're looking at 34.2, which would leave it unchanged. Labour force participation rate for October seen at 62.7, also unchanged from last. And underemployment in September came in at 7.7%. Just a note here then on what the banks are looking at in terms of phrase non-farm payroll. Citi again posited that the October jobs report is critical after September showed an unexpected acceleration in job growth and a decline in the unemployment rate. The low hiring rate makes us think the labour market is still softening. October jobs will be dragged down by hurricane and strike effects, and the bank is forecasting a soft 90,000 increase. The unemployment rate should be less affected, and we project it to rising back to 4.2%. Markets may fail to find a clear direction until after Friday's jobs report and the presidential election the following week. A 25 basis point policy rate cut in November is very likely. In our base case, further softening in jobs will have the Fed cutting 50 basis points in December. Now, if you followed the Citi logic, they were calling before we saw the beginning of the new Fed cutting cycle. They were looking for 50-50-50 for the last three meetings of the year. They revised and tempered that to 25, 50-50, and then they tempered it again. Just in terms of tomorrow's jobs report, I think, in my mind at least, it's almost going to get discounted because of all the disruptions we've had and all the weather-related and the union-related issues we have. Is that something you'd agree with?
Yeah, those tend to be one-offs, not going to, be something that we're thinking about in 2 or 3 months from now. I think you said 101,000 is the expected number.
Yeah, that's the consensus that I had from earlier.
So that's significantly lower than the last 3 months. Obviously, it's significantly lower than last month, but I think we had 115 in July, 160 or something in August, and then 250 or whatever it was in September. Yeah. So that's certainly lower than the last 3 months, and as you said, significantly lower than last month's. I guess what will be interesting is if there's a revision to last month's number. That's something I'm going to be looking out for. Yeah. Was that number actually correct? Because it was a heck of a number.
Oh, it was a belter. I mean, if you look at the net revision last month, even that came in at up 72,000. So, I mean, we are going to be seeing, I think, over the course of the next couple of months, some big swings in terms of revisions anyway from the headline number. So it's just, how would you approach that from a trading perspective? I mean, do you trade these? Do you look at this on the whole, or do you take every sort of data point on its own merits and then trade around that? And what's your style in terms of handling these markets and the data?
Well, I'm a technical trader, so I get my edge from technical analysis. So right. I'm been around long enough to understand the fundamentals, and I obviously keep them in the back of my mind. But on a day like tomorrow, there's no way that I would have a position, because for me, it's just a pure gamble. I haven't got a clue what will happen. And even if I had a strong opinion on the number, the revision can completely sway the market the other way. There's just too many variables as a trader. If you're going to sit there and react quickly, if you're a scalper, then it's a dream scenario with the volatility. But for someone like me who's a swing trader, it's just not worth the risk. I'd rather trade after the event or even wait till Monday. Just doesn't suit my trading style personally.
Okay, so you sit on your hands, take in the data, find out, look at the secondary effects in the market, and then have a look at it thereafter. Yeah,
and hopefully see some follow through on the volatility into next week, which would then present opportunities for me. Of course, we've got the election, is it Tuesday? So that's going to be another volatile event, I would imagine.
Yeah, and that's this. And I mean, looking at that, I guess you've then got an issue, because do you then trade around a pre-election market that's going to be skitty and, I guess in two minds as to what it wants to see? Well, from the perspective, I guess the market and the bigger market players know what they know the scenarios they're looking for. I mean, if there's a Trump, we might as well move on to the elections now. So if Trump, who I think is still within the markets, tipped as the favorite candidate here, if he gets in, Again, reading through bank research, they're looking at a slightly more inflationary picture on that front. Although I think they both have their inflation mark put all over this election if they come through and win. How would you look at the election in terms of from a trading perspective, and would it be another thing? Would you again stand back and just wait for the dust to settle before getting involved?
I probably would. I wouldn't run a position over it, but it will be interesting. I believe that Trump is more sort of, well, the economy would be expected to do perhaps slightly better under him. I'm not really sure if that's the case, but he's probably more of a spender. I do remember when he got in the last time, he wasn't expected to get in. And as soon as it was obvious that he'd won, stock markets collapsed. I mean, there was quite a big sell-off. And then suddenly it seemed like everyone thought, oh, hang on a sec, he's going to spend money, cut taxes, and there was no looking back. Stock markets just went straight up from that point. So there could be quite a big reaction on the day on the result. Although it's unlike he was not expected to win at all last time, so that was a huge surprise. I don't think we're going to get surprises of the same scale on Tuesday.
It's going to be quite interesting. I mean, when you look at, I'm reading from The Hill and their morning report today, and they say Americans still believe the economy, or at least their finances, are a wreck. And they say the piece says former President Trump will campaigning Wednesday called the economy a disaster and promised that if he's elected, he will rapidly defeat inflation. I guess on the inflation front, you can use that as a stick to beat the Democrats with. But as we've also seen, inflation is now coming off and has come off back to target, and and is expected to continue to soften into the new year. So I guess from a perspective of the electorate, where are they most? I mean, I'm asking you the question: what they're most worried about, I guess, and you won't be able to answer that any more than I will. But I guess the economy matters most to them still, and on that basis, you think it leans towards Trump. Do you see anything in Harris that would give you any kind of comfort that she'd be able to handle the economy any better than Trump, for example?
I guess, well, she's the unknown quantities, quality, whatever the term is. We've seen what Trump would do before. I don't know whether that makes him a safer bet in the eyes of the US electorate. It's quite interesting, though, that Citi think that they, even having scaled back, sorry, I'm going back a little bit, but it was a point to note. You said that Citibank had expected 3 cuts of 50 basis points, which was pretty aggressive. They've scaled that back to 1.25%, which I still think is pretty aggressive. So that would take rates down to 1.25% from the high when inflation hasn't actually hit the target yet. It's quite a lot to think about there, really.
Well, their argument, and I'm paraphrasing, was based upon the fact that they thought growth would continue to slip, and obviously therefore have a negative impact on inflation. They were looking, I think, in their original thing, they thought this economy would dump before year end, and they wanted the Fed to get ahead of any that scenario. Obviously, I don't think we're not seeing a dump in the US economy. I doubt we'll get that, and therefore but I think they're given their dues, they're sticking to their guns really, and still think we should force through, or the US should force through further cuts. So if that's their view, and they're sticking with it. They look for I'll read it here. It says, well, shelter inflation in CPI and PCE will be based on rent data and could remain volatile over the coming months. Subdued housing demand should support further slowing, and this would be one of the first channels to see any reflation risk from Fed rate cuts. And so far, that risk looks very low. So in their heads, they still see more risks to the downside for that US economy. So on that note, again, and they're one of a number of analysts out there, but it was just interesting to pick up on the Citi note, because they persistently look for and think there will be a slowing in the economy.
Yeah, that's interesting. I don't think the outcome of the election will probably change that view significantly. Maybe if Trump gets in, then the markets might expect a slightly stronger economy. I really don't know, but be interesting to see if any interest rate expectations change after the election, or even after tomorrow's big number.
Okay, so from a technical perspective, then you've been looking at the dollar, and you said you put it down to more of a short squeeze. Any other currency pairs or any currencies that if we look back at this week's UK budget, the 40 billion in terms of what she was looking to raise wasn't unexpected, and obviously we slightly higher borrowing requirement, and therefore DMO set to issue more near just shy of 300 billion sterling worth of bonds. Do you see any long-lasting effect on the pound from a technical perspective, at least? Where do you see the pound, or what do you think about the pound at the moment?
Yeah, I was watching the pound obviously yesterday. Didn't really move much at all. There wasn't much of a reaction. So as you say, it was pretty much as expected. I focus on cable mostly, and that I could say it's been in something of a bull trend. The pound has been strengthening against the dollar. And even with the dollar strength that I talked about recently, the dollar index has performed extremely well. But I think it's the euro that's been hit mostly. Cable's actually held up quite well. But just as a pure trend follower, I feel that perhaps the pound can continue that trend going forward.
Okay. Any particular levels well, again, you look at all the worries we saw going into the budget and the fear mongering that was being put out there. We haven't had a trust moment with this budget. It may be disappointing to some, and we may be borrowing more than expected. But overall, would you grade it in terms of a success for the labour market that they've managed to steer through any big market turmoil?
I'd say that the pound is suggesting that's the case. Maybe they telegraphed their intentions well enough for it to be absorbed by the market, and the pound didn't really take a hit. We're just hovering around 130, so it's a big number, big psychological number. I guess the question is whether we can start pushing back up through 130, or we hold below it.
Yeah, that's probably the question now, because we've been it's been subdued for a while, I guess, on that level.
Maybe we already had the reaction in the pound for the budget, because it has softened recently. It had actually broken above a really important, I think it was a 14-year trend line. I actually forget the break point now, but it wasn't far below where we are. I think so. The next couple of weeks could be important as to whether it will be important as to whether the bull trend continues and we can get back above that 14-year trend line, that 14-year descending trend line. That's what I've got my eye on anyway.
Okay, cool. Just from a bank perspective, I've got a Deutsche Bank piece here from Shrivas Gopal of Deutsche Bank Research. And Gopal says it's 30 days, but the immediate price action following the conclusion of the Chancellor's budget has not been favourable for our constructive bias on sterling. They said, to be sure, the sell-off across the gilt curve is likely partly reflective of higher than expected issuance projections after the current fiscal year, 25-26 onwards, to which sterling's beta has often been low on budget days, as we had previously highlighted. So basically, the fact that UK equities are not materially underperforming peers this morning suggests that the overall market is adjusting to a larger than expected fiscal event and expecting a more hawkish Bank of England as a result, rather than incorporating idiosyncratic fiscal risk premium across the UK assets. So again, it bears out what you're saying, really. And I think in terms of the Bank of England, there are two camps. There's, we've heard from Andrew Bailey, we heard from Hugh Pill in recent days. We've even heard from Green, one of the more hawkish members of late. But generally, there are two camps. There are those that think it's right to cut in November, and those that are still just saying wait. I don't think they're saying don't cut. I think they're just saying we're willing to wait and see how things pan out. And now we have this out the way, the budget. It's going to be interesting to see if the language changes as we head into that next Bank of England rate decision. But maybe that's a chat for another day. Right, just before we close this out, really, because as I said, I think in terms of data points, we discussed the inflation data. We don't really see, or there isn't really a case for looking at any rate trajectory change from the Fed based on the core PCE data, unless it comes way out of line, really. And in terms of non-farm payroll, again, that's clouded by what we've by the hurricanes that we've had, by the union disruptions. So that muddies the water and gives anyone an excuse to sort of say, well, that's because of that, and to discount October's reading. And then we look to the elections next week, the US elections. Trump's favored, so it would probably be more of a positive reaction in the markets from his victory, if that's the case. Do you see anywhere, if this is a prolonged and drawn out vote counting situation for the dollar, what would you still stay on the sidelines? Would you try and pick, from a trend perspective, would you try and pick points and just and top and tail? What would you do in a situation like that? Just for some of those guys out there less experienced and wanting to know how to sort of handle that.
Yeah, well, the dollar has been in something. Now, I haven't got my chart in front of me, but I'm going to talk about the dollar index here rather than any specific pairs. But the dollar has been in, I think it's a 2-year channel, sideways channel. Very, very obvious to see if you look at a weekly chart. And it did, as I said earlier, bounce from the lower end of that range. Really strong bounce, faster than I would have expected it. So it says to me that there is a bit of a short squeeze built into that. I know we had a strong employment number last month, but I'm not sure if it warrants such a strong move. So I'm guessing that there's been some stops triggered, and there's hardly a red candle visible in that whole move. But for that reason, we are getting near the upper end of the range. So the question is, will sentiment change again at the upper end of the range? It's an opportunity. It probably is worth selling the dollar at the upper end of the range, because if it was a short squeeze and everyone's been stopped out of it, just like that move we had in the yen in July, a brutal move, but it did stop and the market has reversed since. So maybe we'll see something similar in that dollar index. But then if it does break above that upper range of the last 2 years, that would be a significant breakout. And I hope sooner or later the dollar does break the range, because I don't like ranges, I like trends. And I'd like to see it either really start to move to the upside or the downside. It makes my life a lot easier if I can jump on a trend.
Yeah, fair play. Okay, Jason, listen, thank you very much for taking part today in what is going to be a tumultuous, I think, end to the week and all next week, I think, really, and may well set the tone for the rest of the year as we start to wind down heading into Thanksgiving and Christmas. But thanks again for your input. And I'd like to just point out, you can catch Jason on X, daytradeideas. .co.uk is his website. Look for him there. He has a YouTube channel where he publishes his own content as well. So have a look at that. I'd very much advise it, because I've known Jason for a long time, and he's been around a long time, and he knows what he's doing. He's made a success of what he's doing. So please go and check him out. daytradeideas.co.uk. I'll post all this stuff up afterwards as well for those who want to try and find him on the internet. But Jason, thank you again. And guys, just to quickly just round off here. So you got this has been recorded on Thursday. Obviously, this will also relate to tomorrow's non-farm payroll. We'll try and squeeze in an election preview with some guests as well before the actual voting takes place next week. But as I said, it's going to be one of those tumultuous affairs, I think, for the markets this year. But yes, good trading today, and thank you for listening in. And Jason, I'll be in touch, and we'll chat again soon.
Cheers, Harry. Thank you so much.
Thanks a lot. Thanks for tuning into the Live Sport podcast. Your edge in the market starts here. Subscribe now.